A successful enterprise operates like a precision machine. Capital, supply chains, and human leadership interlock to keep operations moving smoothly and profitably. But inside this intricate machinery sits a massive, often unaddressed point of failure: the sudden mortality or permanent disability of a founding partner. When a key leader abruptly disappears, the gears grind. Surviving partners are suddenly forced to run a compromised operation, while the deceased founder's heirs inherit ownership shares in a company they may have no interest or experience in managing. Without a pre-engineered fail-safe in place, the sudden loss of a partner introduces severe structural instability that can threaten the survival of the entire enterprise. To prevent this operational collapse, business owners draft a buy-sell agreement. This legal contract acts as a blueprint, outlining exactly how an owner's shares will be transferred upon their exit. Yet, a blueprint on paper is powerless on its own. If the surviving partners do not have the immediate capital required to actually purchase the deceased partner's shares, the agreement fails. Attempting to fund this buyout during a crisis rarely works. Large cash reserves sitting idle lose value to inflation, and banks frequently deny emergency loans to a business reeling from the loss of a key executive. The enterprise might hold millions in total valuation, but that wealth is locked inside equipment, real estate, and inventory. It is highly illiquid and cannot be easily carved up to compensate a grieving family. An unfunded legal document doesn't save the company. It merely specifies the administrative steps towards insolvency. The most effective way to guarantee necessary capital is pre-funding the agreement with life insurance. It delivers predictable liquidity precisely when the emergency occurs. Rather than relying on a basic death benefit, many partnerships utilize Indexed Universal Life, or IUL, insurance as a dynamic financial instrument for this exact job. The moment a triggering death occurs, the IUL policy releases an immediate lump sum of cash directly to the business or the surviving partners. Beyond the death benefit, IUL policies also build cash value over the lifespan of the business, growing on a tax-deferred basis. This accumulated pool acts as a living reserve. If a partner faces permanent disability or decides to retire, the business can tap into this cash value to finance their buyout. By integrating an IUL policy, a company turns the unpredictable timing of a tragedy into a guaranteed, fully liquid capital event. To route this capital efficiently, the insurance mechanism must be wired specifically to the size and architecture of the company. This network graph illustrates a cross-purchase agreement. Each distinct node, representing a partner, purchases an individual life insurance policy on the others. When one partner exits, the policy pays out, and survivors use those funds to acquire the deceased's shares. This structure carries a distinct financial advantage. The surviving partners receive a tax-free step-up in basis, drastically reducing their future capital gains tax exposure. For complex systems, the structure changes to an entity purchase agreement. With multiple owners, individual policies are impossible to manage, so the central company hub purchases them. If an owner passes, the business entity itself redeems the shares, executing a clean, centralized buyout. Deploying the correct structural circuitry prevents administrative gridlock and completely maximizes the financial leverage of the remaining partners. The absolute efficiency of this fail-safe mechanism depends heavily on operating strictly within the parameters of the IRS tax code. Under IRS Section 101A, the massive life insurance payout used to execute the buyout is distributed entirely free of income tax. When properly engineered, specific corporate structures like S corporations and LLCs can leverage this provision to bypass double taxation when shares change hands. Compare this to traditional liquidation. Selling real estate under duress triggers severe capital gains taxes, slashing the actual cash available. Structuring the agreement according to these specific provisions ensures every dollar of the fail-safe goes towards saving the business and compensating the family, rather than paying government penalties. Building this complex system requires exact calibration by legal and financial professionals. First, owners work with an attorney to draft a legally binding contract. This document dictates the exact triggering events, the payment structure, and the rules of succession. Second, the partners contract an independent expert to establish an objective, undeniable valuation of the company. Finally, the ownership and beneficiary designations of the life insurance policies are structured to perfectly mirror the terms of that legal agreement. The fail-safe is only as reliable as the meticulous professional blueprint behind its construction. But a successful enterprise is not static. As market share expands and revenue climbs, the total valuation of the business naturally increases. Look at this chart. Growing bars represent the business's rising value. If the life insurance policy remains a static flat line, a dangerous funding gap opens up. To maintain protection, owners must regularly update the valuation, layering in supplemental coverage to match the company's new mass. This continuous calibration guarantees that grieving families receive fair market value, while surviving partners are never caught with a funding shortfall. A fully funded, strictly calibrated buy-sell agreement protects grieving heirs, guarantees a seamless transition for surviving partners, and secures the enterprise against the unpredictable forces of life.